Coronavirus has affected equities and government bond yields, but do investors need to worry about underlying debt? That's been a question that's persisted these past couple of weeks, and Steve Liesman joins us now with perhaps the answer. Steve.
Thanks, Andrew. Top executives at all three major credit rating agencies, Moody's, S&P, and Fitch, tell CNBC they're closely analyzing the potential effects of the coronavirus on corporate, municipal, and sovereign debt. So far, there have been only a handful of rating actions directly related to the outbreak, but that is expected to change. Over at Moody's, they told me, definitely something that we're monitoring very closely. S&P said there will be more ratings actions and the pace will quicken. Fitch says it hasn't downgraded any companies yet due to the virus. S&P has changed 27 credit ratings because of it. It placed Samsonite on ratings watch negative on Monday. It had earlier flagged Sabre and Wynn Resorts, and that kind of tells you the debt's attracting the most scrutiny. Some airlines with weaker balance sheets, other companies in travel and tourism, and countries that rely on those revenues. In other words, the sovereign debt that rely on those revenues to service the debt. Commodity companies also being watched carefully, along with countries relying on commodity revenues. The concern is not focused on investment grade. A lot of that has been refinanced, termed out at lower rates into the future. The main worry is speculative grade debt, and that should raise a red flag for investors going down the credit ladder who are hunting for yield. There will be credit risk in there. Fitch says as the virus spreads to other economies, including the U.S., a greater number of leveraged corporates may find their production disrupted and their revenues pressured. Rating agency executives said there is considerable liquidity in the system. Creditors remain willing to lend. You need that side if you're really going to have a credit crisis, so we don't have that. While some spreads for speculative debt have widened, rates have fallen, so that eased the burden on corporate cash flows. And some companies or countries could get relief from either government agency bailouts or the IMF or the World Bank if those programs are passed. But it's also true that the extent of the economic effects remain unknown. Craig Liesman, head of analytics and research at S&P, told me it's all hands on deck. We need to be proactive. We can't wait until the economic effects are already obvious. And Andrew, you know what happened the last time we had a crisis, which is the rating agencies were widely criticized and behind the curve. I get the sense that they're sort of on their game on this one and really trying to stay ahead of it and not and avoid that criticism that they had in the financial crisis.
See downgrades constantly.
I think you'll see the first step is not downgrades, it's credit, it's ratings watch negative.
Right.
And I think they'll flag that stuff. They're already, you can go, for example, on either the Fitch or the S&P website, and there's a lot of research there for people to kind of read and figure out. And it's difficult to gain, but the idea that more and more of this is happening more quickly. But you have lower rates. You also have this liquidity in the system.
Right.
And that liquidity, you need two sides to make this a crisis. You need the lenders not to lend and the borrowers be unable to borrow. We don't have that side on the left here, which is still have people out there looking for yield, but they should go in with eyes wide open. There's potential underlying credit issues.